Sticking with the cattle theme, and we have a look at cattle markets this week with UNL Livestock Market Analyst Elliott. Spoke with Elliott on Tuesday and began by asking about the current state of beef demand.
So beef demand in the fourth quarter is going to be down a little bit by about 0.2% year over year, so in comparison to 2019. One of the good resources that I refer to on what is potentially beef demand going to look like in regards to either at home or retail is called the Retail Demand Monitor out of K-State, and they actually specifically asked people, what is this expenditure going to look like on specifically beef? And about 75% of people say they're going to be consuming as much or more beef this year than they did in previous years. That just goes to show that even though we're not maybe having these large gatherings, there is still a desire to consume particularly beef, and this goes for other products as well. An example would be with turkey. During this Thanksgiving, people thought, well, maybe turkey's down, but actually throughout the pandemic, turkey actually is one of been the largest benefactors. A lot of people have been buying turkey, they've been eating it, and even with smaller gatherings, more people bought turkeys than we originally thought.
Let me get a quick question about this month's Cattle on Feed report too. What are some things that you'll be looking for in the report, and what are some things that you would advise us to pay attention to?
So as we're coming out of the pandemic, things are starting to open up a little bit more. We saw a record number of placements. So that was we had pretty terrible demand going through the summer. We were down about 8% throughout the year. Then we're coming out, a lot of people started placing cattle again, and now we're at a situation where people are starting to back off a little bit now. They're starting to realize that maybe we overplaced a little bit, and this next cattle on feed report that's coming up, analysts have that at about 90% of 2019 in November. So those are November placements. What do we look like compared to 2019? It's about 90% of what that is. Marketings are still about 97% of that, analysts suggest. But on average, we have the same number of cattle on feed. So even though we've placed less, because we placed so much in September and October, we're pretty much at where we need to be. So I think people have already kind of priced in their expectations. They placed a lot of lighter animals coming off of grass, and now we're just kind of waiting for what is going to happen in these next couple of months. But definitely set to capture those premiums in April, May.
Elliott, we've been talking on the show for the last several weeks about higher grain prices. What advice would you have for the cattle producer who is having to make feeding decisions and figure out their input costs?
Yeah, so maybe I'll speak specifically to distiller grains, which tends to be a large input use, and a lot of people who were adversely affected as ethanol plants started to shut down. Obviously, we know distiller grains, either dried, modified, or wet, are co-products or byproducts of ethanol production. During the summer, when there were all the shutdowns, people weren't driving as much, ethanol price dropped, and so as a reaction, the ethanol plants decided, hey, we have to idle or completely shut down, particularly in western Nebraska, where people relied upon distiller grains. Then when those weren't available, people were left kind of scrambling. One of the things that I look at is recognizing from the animal scientists that they say distillers grains have value above corn as far as protein and energy. I look at what the price is compared relative to corn. And right now those have been trending up, but they're seasonally trend. They always seasonally trend at this time. Particularly right now, the wet distillers grains relative to corn prices on a dry matter basis is about 1.2, which means it's about 20% more expensive on a dry matter basis. But what that implies is that as long as you feel like you're getting more than 20% of the value back relative to corn, then you should be okay. And although prices are trending up, they tend to be kind of seasonally, they tend to seasonally trend this way. But we are seeing a little bit stronger pressure just because corn prices are just so high right now.
And Elliott, let's end things today with any marketing or risk management decisions that you want to mention to us that we haven't talked about yet.
Yeah, so a few weeks ago, USDA RMA, in conjunction with broader USDA officials, hosted a webinar here at University of Nebraska and Department of Ag Econ. There we went over for about an hour and a half about livestock risk protection and all the changes that have happened. Large modifications to that. In some cases, depending upon the coverage level there, the government is basically paying 50% of the premiums for producers. I went ahead and compared that to what it is for CME options. So if you were to go and buy that in Chicago using a put, these are incredibly valuable. And of course, you have to be diligent on, ensuring how you manage that risk, but really looking into LRP as a source of risk management. I would really suggest, and we have those tools and resources from the Department of Ag Econ that are available for producers to use.